Ways to cut retirement taxes. One of the biggest expenses retirees have is taxes. In addition to budgeting for housing, healthcare, and hobbies, considering your tax bill should be top of mind as you're planning your retirement expenses. Today we're going to chat about ways you can save on taxes and keep more money working for you and your family. Strategy 1. Transfer assets to tax-advantaged accounts. Many retirees have a drop in income when they step away from work. This may allow you to strategically move assets from pre-tax accounts that are saddled with a future tax bill to tax-free accounts via Roth conversions when you're at a low bracket. This creates more flexibility on taxes and access in the future. Figuring out where you fall in your tax bracket and reassessing your income and distribution options each year will help you maximize income at the lowest tax brackets for long-term tax savings and efficiency. This strategy works particularly well for folks with high balances in pre-tax retirement savings like 401ks and traditional IRAs. Strategy number 2, tax loss harvesting to offset gains. If you have saved into non-retirement accounts, considering a strategy called tax loss harvesting may allow you to create tax opportunities, especially in times when markets are volatile. The idea is that you sell securities to lock in losses, which will offset some income, up to $3,000 a year. Any additional losses can be carried forward year over year. Locking in losses doesn't mean you have to get out of the market. You can strategically reinvest your assets to maintain growth potential while simultaneously utilizing the losses for tax efficiency. Strategy 3, qualified charitable distributions. For those who are charitably inclined, there are a number of ways to increase the tax efficiency of how you give your money away. If you give money on an annual basis, a qualified charitable distribution, or QCD, may make sense. This strategy is to send money directly from your pre-tax retirement account to the charity of your choice. If the money never passes through your hands, it goes to the charity tax-free without showing up as income for you. There are several rules around this strategy, but used appropriately, it can help lower income taxes without having to itemize charitable contributions. A QCD can also satisfy required minimum distributions. Other considerations for the charitably inclined are to ensure that beneficiaries on accounts are set up to increase tax efficiency. Friends and family can be listed on tax-favorable accounts such as Roth IRAs and non-retirement accounts, and charities can be listed on pre-tax accounts to make sure more money goes to the intended party rather than to taxes. Strategy 4, asset location. What types of investments you hold in each of your accounts can also have significant impacts on the total taxes that you pay over time. Your investments should not look the same across all of your accounts. I usually say that you want to be your most aggressive version of yourself in your Roth IRA. Because all that growth is tax-free, you want to have your highest growth assets in that account. In non-retirement accounts, it makes sense to hold investments that have their own tax efficiency, since there's no tax deferral. Income-generating assets are best held in tax-deferred accounts to minimize the tax drag on income until you're ready to use it. These are just some tax-saving strategies in retirement. With the uniqueness of every personal situation and every portfolio, it's important to find solutions that work best with your goals and asset mix. To learn more about tax savings in retirement and what strategies may work for you, contact Pure Financial Advisors for a free tax analysis.